This is our Forex blog for June 29th, 2012. And on days like this where there's fundamental reasons for the euro's incredible strength, you're going to get just explosive moves that just keep going and going. And they also are much more likely on days like this to go outside of our green upper bands. Normally, the green upper band is a line in the sand. If the market does happen to hit it, it usually falls 30 to 50 pips. On super strong days like this, the market can go above these levels and just keep going. Again, it's very rare. One out of it, maybe every 8 days, one out of every 10 days, maybe even one out of every 15 days during certain months. Are you going to get this? Most of the time, statistics play out. The market hits usually the white band and then reverses. So I'm going to go over a new tool we're going to release next week that will help you trade days like this. When do you, what's enough of a pullback to make it worth getting back into the trend? And so we're going to go over that. But our normal system is using our currency meter. We have a 3-step easy Forex trading system. Find the strongest currencies and the weakest ones. You can see the Swiss very strong today, Euro strong, the Australian strong, and the weakest ones are the dollar and the yen. So obviously you want to buy the euro dollar, you want to buy the euro yen, and once the market gets above these bands, I have fewer and fewer buy signals on the chart. Normally traders wait for buy signals and then they get in. The problem is these buy signals are designed to show high probability potential buys and sells, and you can see last night our buy signal right here during this breakout showed up, and the trailing stop had you in here somewhere around 52 all the way up to 26.14. So you made about 160 pips. That's probably one of the biggest moves I've ever seen. And notice where the trailing stop gets you out right at the end. When the market has gone up too much, you could wait for a decent sized pullback in proportion to the move up. Wait for the trailing stop to get hit, and get in, small profit, get in, small profit, get in, break even, get in, small loss. Then at that point wait for a deeper pullback. What I suggest people do instead, when we release this new tool, it's our Fisher transform shown on a range chart. And on big days like this, where it takes off, wait for a pull. Normally you want to wait for a pullback down to the lower -2.5 band. When it comes down here, it's temporarily oversold and allows decent entries right here, boom, right here, boom. But when the market is up too much, a lot of times you can wait for a pullback near the zero line, which is in the middle. So pulls back, which is pretty much right around here, and then it breaks out. So you could have taken that breakout. This pullback trade right here is not enough. Look, notice it hasn't even come close to the zero line. As you go forward, at this point right here, it's very close to the zero line. You wait for a pullback, the green bar up, you buy, it goes from 75 all the way up to 94, almost 20 pips. And this one did make a higher high, so I would probably avoid this trade here. And then when the market pulls back here, you do have a decent pullback right to the lower level. This market's super strong. This is a relatively safe place to get in at 60, goes all the way up to 90. Nice 30 pip win. So by waiting for at least a pullback on super strong days like this, the zero line, you at least have a chance to, I hate to even use the word safely, but more safely or less riskily, get into a pullback. And during normal trading times, this is a wonderful tool that shows you. It goes back 500 bars. It shows you last night, right, as this thing's coming down. At this point right here, you could have considered a buy. It's about a 35 pip pullback. That one would have probably broke even or made you maybe 5 or 10 pips. And then it came back down, and now when it's underneath here, it's much higher probability to buy. And you can see it went up. Pullback right here, it also went up. Waiting for pullbacks to the -2.5 is a much higher probability, for buys than looking to buy up here when it's already oversold or overbought, I mean. But when the market first takes off, you might consider a little pullback like this to be the only pullback you're going to get it. So, first wave up, second wave up, and then kind of wait for it to settle and pull back either to the 0 or the -2.5 level. And we'll show this now also on the euro yen. So here's the euro yen. Let's first look at looking for buys when it's down here near the lower, minus 2.5 area. The market goes up, pulls back again, goes up a little bit, pulls back again right here, goes up, pulls back. You can see it's, had a decent sized pullback, goes up. Again, here's the next area right here, goes up. Now the market's so strong it's not even pulling back to the minus 2.5. So again, if the market's going sideways, at least wait for this to pull back enough and come real close to the zero line. And that is, I've always taught that two of our methods of getting into trades is pullback trades and sideways rectangle trades. In the past, I've always said wait, 20 minutes to 2 hours. The longer the rectangle, the better. Now in this case, we now have a mathematically systematic approach that when the market makes enough bars that causes this indicator to pull back near the zero line, anytime it explodes over the upper 2.5 area, you might want to wait for a pullback to the zero area. And at this point, when it's right here, right near the zero line, you wait for the breakout, you're in. And you can see, again, very close to that zero line here. Now, when it hits that zero line, it's already going up, so you missed that trade. You might have bought this pullback right here, made a little bit, and then here's a more idealized pullback area. And you can also, and we always taught this for 5 years, draw a trend line over those bars high after the pullback. When it's down to a safe area right here, wait for that trend line to get broken and get in. And you can use trend lines to get in and out of the trades as well. There's no need to, just use them on one side. In, out. And you always want to draw fibs too to have an idea of where your profit target is. So you draw that from here to here. And notice it went right to the 1.618, a few pips above it. That was the end of that move. And usually the more waves it goes up, the more of a pullback you're going to need. Here's a 38% pullback. This is also pulled back enough. If you got into a trade here, you might have had a loss, small win, small win. We're back up to live trading here. Also, with the euro dollar, let's look at the daily volume profile chart. We released this last week. This shows the value area, and above the value area, the market's much more likely to go up. It allows you, in some cases like yesterday's, to buy a breakout of this area versus the high of the day. Now, obviously, this move up today was fundamentally based, but you will find this to happen even on days that news doesn't cause market moves. It's just normal trading. Typically, when the market breaks out of the value area, just like yesterday when it broke down through 2 days value area lows, right here around 24.66, price fell all the way down here, fell 60 pips. And you were able to get into that trade, instead of 45, you were able to get into it at 70. So a nice 25 pip earlier entry yesterday on the short, and today when the market opened and it was above the value area, you were looking for buys even before that, fundamental news caused the move up. Now we see that the Swiss was also extremely strong, especially in the U.S. session, right? The dollar was weak, so you want to sell the dollar Swiss. So, especially after 8 when the dollar became really weak and the Swiss became really strong, you have that trend line break right there as well. If you miss that first wave down, notice again the Fisher Oscillator got way below the oversold area, and when that happens, you're usually not going to get a pullback up to the upper band. So when it comes close to the zero line right here, breaks down, you go short. Comes close to the zero. In this case, when it comes back up to the zero line, it's already falling a little bit. You have another pullback up, short and short. And then the farther down it goes, the more likely it is to make a pullback up to the 2.5 upper oversold area, or overbought area, sorry. And at that point, you can usually look for sells. But during normal trading, when the market's not exploding, it makes a really good overbought oversold indicator. Look, the low, the high, it was a little bit early in picking the high here. And you can also use this for divergence trading. Not the best earlier today. But if you ever get a higher high on price and the indicator has a lower high, typically that's a major reversal area. I'll go over that more next week in classes. But on days like this, when the market moves outside of our bands and therefore the FX trade signals typically don't show any more trend trades because they're statistically low odds. I don't look for sells underneath the lower extreme bands or buys above the upper bands. Because of that, you can use this to trade on days like this very well. And it also can help you know which of our trade signals to take. Once on a normal trading day, if the market goes down a lot, wait for this to pull back up to the 0 line or the upper 2.5 over bought level before you look for sells, and you can get rid of a lot of unnecessary losses.